Good morning. Welcome everyone to the COFIA's webinar. I'm John from COFIA and I'm the moderator of today's event. We would like to note that today's webinar is being recorded for internal use. By remaining on the call, you consent to such a recording. Let me begin expressing special thanks to TransLink and then TTCP speakers joining from San Francisco. Andrew, if you're around, I'm gonna make some introduction. The Korean viewers in Korean, okay? 오늘 세미나 진행과 관련해서 간략하게 설명드리겠습니다. 오늘 웨비나는 영어로 진행될 예정인데 국내 참석자가 대부분 한국 분임을 감안해서 한국어와 영어로 병행하면서 진행하겠습니다. 오늘 세미나 발표 자료는 세미나 이후에 저희 홈페이지 게시판에 게시할 예정이고요. 그다음에 오늘 저희 웨비나도 레코딩이 돼서 게시될 예정이니 참고하시면 될 것 같습니다. 오늘 세미나 진행과 관련해서 우선 트랜스링크 한국 대표로 계신 박희덕 대표님께서 이제 트랜스링크에 대해서 간략하게 소개해 주시고요. 이어서 앤드류 케이디 그리고 김범수 대표님 등의 스피커들의 발표를 듣고 Q&A를 진행하도록 하겠습니다. 끝나는 시간은 대략 11시 좀 넘을 걸로 예상되고요. 플렉서블합니다. 그리고 이제 또 보시다가 질문사항이 있으시면 질의는 편하신 대로 한국어 또는 영어로 해주시면 저희가 스피커에게 전달해서 답변 드릴 수 있도록 하겠습니다. 우측 하단에 있는 질문 메뉴 등을 활용하시면 될 것 같습니다. 그럼 우선 오늘 이벤트를 저희 함께 준비해 주신 트랜스링크의 박희덕 대표님 인사 부탁드리겠습니다.
네, 안녕하십니까. 트랜스링크 인베스트먼트의 박희덕 대표입니다. 저희 회사는 2016년도에 설립이 된 벤처 캐피탈입니다. 근데 실제적으로 저와 김범수 대표는 한 20년 이상 미국과 한국에서 벤처 캐피탈로 활동해 왔는데요. 실질적으로 이제 설립을 2016년에 해서 한 만 5년 정도 된 신생 창투사인데 한국에 한 35개 정도의 시리즈 A 쪽 투자 포트폴리오가 있고요. 미국에 한 20개 정도의 투자 포트폴리오들이 있습니다. 상당히 지난 5년간 활발하게 한국과 미국 그리고 동남아를 연결하는 고잉 글로벌 미싱 링크하는 그런 투자 시스를 가지고 활동을 열심히 하고 있습니다. 최근 들어서 한국의 그로스 캐피탈 시장이 상당히 이제 유니콘들이 많이 성장하고 뉴욕이라든지 샌프란시스코, 싱가포르, 홍콩의 어떤 투자가들이 한국의 투자에 대해서 관심을 많이 갖고 있고 저희 회사를 통해서 한국에 투자할 만한 것들을 많이 문의를 하고 있는 상황이고요. 아울러 저희들도 저희 투자 포트폴리오뿐만 아니고 한국에서 차기 유니콘으로 성장할 만한 회사들을 가지고 있는 정보들을 상당히 저희가 가지고 있는 해외 네트워크들, 실리콘밸리뿐만 아니라 해외 네트워크들하고 같이 이렇게 한국에 투자할 수 있는 기회를 서로 만들어 나가고 있습니다. 오늘 발표는 저희 실리콘밸리 현황에 대해서 우리 김범수 대표가 진행해 주실 거고요. 저희가 저희 투자에 대한 저희 펀드에 LP로 들어와 있는 샌프란시스코에 있는 TTCP 측에서 미국 펀드를 하는지 트렌드 현황에 대해서 발표를 해 주실 예정입니다.
Well, welcome everyone. We are here to present the state of venture capital and give an update on the industry and why we're excited to put money into the space over the next 10 years. So Katie and I, we work for top tier capital partners. I've been here for 5 years now, working on the fund-to-fund side and also the direct and secondary side. We were founded in the early 2000s, have raised over $6 billion in capital commitments, based in San Francisco, where most of our activity is, but also have an office in London and Boston. And I'll let Katie introduce herself really quickly.
Hi, everyone. Great to be here with you all today. I'm Katie. I've been at the firm for a couple of years now, focusing on the fund investing across technology, healthcare, and mostly in the United States and a little bit internationally. As Andrew mentioned, most of our international exposure is through Europe. So we invest across the capital stack.
Yeah, a little bit about us. So our core program is a fund of funds, venture only is our expertise. It's all we do. And we concentrate capital into the brand name established emerging managers. And then we also look at emerging managers that we think can become the next brand name firms that you would typically think of when you think of venture. We also do secondaries and co-investments. On the co-investment side, come in typically at the Series B or C stage. sector-wise, mostly enterprise, but we are agnostic and we'll do things in fintech, and security, and consumer, and logistics as well. And then we also have just regional focused funds. So we have a fund focused on Europe and Israel, where we're deploying primary, secondary, and co-investment capital into the region. And that's why we have the office in the UK. It's a region that we've been excited about and investing in for the last 15 years. And then with that, today we'll talk about a little bit about the venture market, give an update on that, the exit environment, how the venture ecosystem is changing from how venture firms are being built today and how they're deploying capital. And then we'll also talk a little bit about industries, talking about software and some of the innovation that we're seeing on the business model side. And then we will wrap up and have Q&A at the end. So I'll pass it to Katie, who will cover the market and the exit environment.
Thanks, Andrew. I'm going to start off with just a brief market update and then go into some of the driving forces of what's happening on a macro level, of just the elements that are taking place in the venture capital ecosystem and the fundraising environment. And then Andrew will wrap it up with some of the larger tailwinds across the industry. I think just to start out, venture continues to outperform other indexes. I think we could probably go to the next slide. Including the public markets over each of the following time horizons, so 3, 5, 10-year benchmarks. And this is really driven by several larger tailwinds happening across the industry, and primarily due to the changing ecosystem that is taking place on the private markets, which we'll dive into. Firstly, I'm just going to talk a little bit about the deal volume, just to set the stage here. And so demand in general for, sort of the mega deals, that's really driving a large part of the 2021 deal volume, as you'll see since 2018, really a large uptick here. These mega deals are really persisting as companies are staying private longer. And this is bolstered by kind of a level of capital flowing into the private markets that we've really never seen before. In 2021 year to date, so the first 3 quarters of 2021, the first 3 quarters of the calendar year, the US VC ecosystem has seen almost 600 of these $100 million or greater deals, and 200 of which were just in the 3rd quarter alone. So there's really no sign here of anything slowing down. In fact, these outsized, very large deals are really here to stay. Almost 60% of the deal volume in 2021 accounts for these larger, later stage rounds. They're really a large driving force in the ecosystem across the whole capital stack. And then something else I'll note just there is that you're seeing kind of more non-traditional VCs coming into the market. And so the ecosystem in general is becoming more crowded as more investors over different capital areas want to capitalize on these returns in the private markets. And VC exits in 2021 are also displaying perhaps the largest and most dramatic growth over the last few years, even when compared to the deal making and fundraising, which I just touched on. But the exit value and count have both seen record highs over 2021, and this is on pace to double that record of 2020 in the previous year. And this has brought over $500 billion of liquidity to the market in the last 3 quarters. It really is due to some of the larger outcomes we've seen on the public side. Robinhood was a large 30 billion IPO, many direct listings, including Coinbase. And so, you can see kind of on the next slide even that all of these logos, including the direct listings and IPOs in which I just discussed, are contributing to this really large flood of public market and just liquidity in general, which I think has been a long time coming in the ecosystem. And now I'll just touch on some of the dynamics and how our VCs and the VCs we work closely with are responding to some of these changes in the macro environment. As in any market, the public markets and the private markets continue to see large changes as the technology continues to evolve and really cannibalize every single sector across the ecosystem at large. And so when you look at kind of VC over time, the last 2 decades and where we see some of it going, This is a very simplified illustration for the sake of time. But when you look at 2001 compared to 2011, you do not see as many differences as you would see today. I think in 2001, you could say the IPOs were happening very quickly if the company was working. In 2011, you see the IPOs slow down a bit. In 2013, some folks were kind of coining the term unicorns to explain how much capital and how much value was accruing in the private markets. And so these two periods are similar in terms of timeline, a little bit more stretched out in terms of exit timeline, but the way that people went about raising capital is frankly very similar in between these two. Then if you fast forward 10 years to today, this is a very different illustration with a lot more nuance, a lot more specialty. VCs today are specializing probably more and more across the capital stack than ever before. You see investors that are exclusively focusing on what we call day zero, which is when startups are really just an idea or a pitch deck. And, they're really not much more than that, but there's a whole institutionalization happening around that stage. You see VCs investing earlier and earlier to create optionality on later fundraising rounds. The lines between a seed, a series B, they've become very blurred. As we mentioned, more investors coming into the space, it's becoming more crowded. There's a difference between pre and post revenue and pre-traction and post-traction, but more VCs are becoming more creative with kind of how they justify certain valuations. I think lastly, capital markets have really rendered obsolete the small cap IPO tech market. And so you can really see companies remaining private longer for more extended periods of time, often in the excess of 10 years versus the 7-year sort of median that we were seeing 35 years prior in this market. And so along the bottom here, you can see that companies are really staying private for 12 to 14 years for the best of the best. And this actually creates a very nice environment for some founders. There's an element of being able to create optionality in the private markets without the public scrutiny of the IPO environment. And so this result is really a robust later stage capital stack evolving post Series C, crossover rounds, more secondary environments happening, and just a lot more opportunity for shares to exchange hands and for early stage VCs to really need to double down on what they've invested in early to maintain ownership along the stack. And so therefore, capital appreciation will occur in the private markets, meaning that, in our opinion, the best venture capital firms will have the opportunity to invest in successful companies at many more stages of the private markets along their development path. Here is really just the proof in what we're talking about. We've been, talking about it amongst our firm for a long time, but I think even just 20 to 21 in the last year, you can see the amount of capital flooding into later stages of venture capital has really just increased dramatically. VCs are doing two things to hold on to their pro rata in these different environments. One, there's the platform effect happening at many venture firms. So VCs are adding more strategies. They're becoming more specialized, investing at different stages that they weren't investing in before. And then two, you really see almost the birth of a select or continuity fund happening across the value stack. And so many of our VCs will raise a later stage vehicle just to double down in the companies in which they're seeing the best activity happening in. So you see a lot of capital flooding into the market. There's no doubt about it. The top gray there being funds raised before, and then the dark gray being funds raised since 2018. We hear a lot about Tiger Global, Sequoia, Andreessen, Insight. All of these GPs are becoming more asset managers than VCs as they've been kind of coined in the past. And I think we'll probably continue to see this as the private markets are valuable. And then lastly, this is happening, across our book, just specifically, this is some of the managers we do business with. And just to drive this point home, only a few of our managers, mostly sector specific managers, two of which being healthcare, and one has a very specific stage in which they play at, have a single GP, single fund deployment strategy. And so these GPs are across our book adding more and more funds. And so the single fund for GP strategy is really becoming a thing of the past to some degree. And then just to take a look at the other side of the market, we spent some time talking about growth, but this is also happening on the early stage side. The seed and the angel environment is becoming highly institutionalized, more so than it has been before. And this steady uptick will likely continue as that environment becomes very strong as well. And then two driving forces there, just to unpack it a bit. You have, again, the platform VCs coming downstream. And so a couple of those logos have come out recently and raised pretty large seed checks and funds. So we'll see how that affects the overall ecosystem for the years to come. But I think the other interesting part of this market is the solo GP. And this is kind of a new asset class within the day zero or the early seed checks. And this is, the angel or the solo venture capitalist or somebody that is writing checks really on an institutional level, but without a team around them. And so they may have a platform and a back office and people supporting them, but they're the sole capital check writer on the platform. And I think, there's all these different factors are contributing to some of the bigger tidal waves we're seeing across the capital stack. And with that, I'll pass it off to Andrew, who's going to discuss some of the larger innovations and changes that we're seeing that can make all of this sustainable.
Great. Thanks, Katie. So I'll talk about some of the innovative things that we're just seeing sector-wise and software, but also how the business models are changing and why we're excited to continue to invest in venture capital over the next 10 years. So first, as far as trends, I'll start with digital transformation. I think we all know this is accelerating, especially in the past 2 years. And I think consumers are really realizing the benefits of just convenience and time saving that comes with moving from offline to online. And we think that time saving and convenience does have some staying power. And we do expect that consumers are just going to expect this going forward. And it's really going to be the mode of delivering value for the future. We see it all over our portfolio at top tier. So some of these companies like Talkspace, which brings therapy online, mobile to your phone. Go Expedia brings the procurement process for industrial customers to help manage and improve the efficiencies in their logistics and also decrease their costs. And then we have Orchard, which brings the buying experience for real estate from end to end, from buying all the way to closing online. And it's also for buyers, but also sellers. And then we have Remitly, which helps you transfer money globally instead of doing it through a bank. I've used it before for a low cost of only $3 compared to going to a bank. It would take me $30 and a few more weeks to actually transfer the money. So we're seeing innovation just all across different industries that we think is super exciting for the world. I think the second trend is the convergence of big data, automation, and artificial intelligence. And with all these three things coming together, we're just going to be able to make a lot smarter decisions and then disrupt legacy players and drive valuable insights. So an example that we have is a company called Clary, which helps you forecast your software projections, your sales projections. So you can see before Clary, this customer had a range of either 20% over or 40% less on their sales forecast. But after Clary, you can see how this narrowed to less than 5%. And with that, CROs or sales execs can actually go manage their budget and execute with a higher degree of certainty. Next is the Internet of Things, but also just the growth of devices and how software is able to now work on all these devices. It really just expands the surface area of software and therefore the market size. So it's something that we continue to monitor and watch here at top tier. And then lastly, considering there are 9 trillion devices out in the world, there's only 26 million developers in the world as of 2019, and you need people to power and create the software that's working on all those devices that we use today. And software development timelines are just becoming shorter, more compacted. It's becoming a lot more complex with the amount of code and APIs that you're integrating into your software. So anything that you can build to help developers just be more productive is a huge win for the industry. And then moving on to just modes of go-to-market, how these have changed and adapted to the current timeline. So, I mean, before 2015, when you had to uninstall and reinstall your software off of floppy disk or CD-ROM, the software was always sold to CIOs and executives who just had all the buying power. It was really only used and purchased by large businesses with like over $1 billion in revenue. So the market size, although it felt big and growing at the time, it was limited compared to what it is today. The pricing models were very subscription based, and the marketing strategy was sales driven and marketing driven. But today, because of the cloud, it's really just enabled a more agile, flexible, more efficient go-to-market motion. So it's focused on the end users, which we'll discuss in the next slide why that's important. Most businesses can now download software just because it's easily and readily accessible on the internet. And therefore, because more businesses, more SMBs can actually just go get it and actually go afford it, and also all the different industries that are using software today, your market size becomes a lot bigger. We are seeing some innovation with the pricing from recurring to consumption-based business models. And what we're excited about is the marketing strategy that these companies have now focused on as far as product-led and community-led marketing strategies, and focusing really on the product experience and time to value. So here, we'll talk about why the purchaser of software is really important. So before the cloud era, it was mostly focused on CIOs and executives who weren't actually users of software, but were buying it for certain features that made sense for what they thought would be valuable. So that's the perceived value. And in the cloud era, now that anyone can go download the software or the product, you can go try it, download it for free. It's typically a freemium type of model. Try it out for a little bit and see if you actually like it. So if you do like it, there's a lot more valuable that you already know is going to happen. So it's a lot easier ROI to justify to making a purchase. If you don't, then you just kind of move on to the next thing, and you've only wasted a few minutes, but have had the experience. And we're finding that when things are valuable and can deliver time to value pretty quickly, those products become really popular. And in this day and age, when you can share a lot of things on social media or with your friends, so you're seeing just viral growth with some of the best products. So it's a consumer-like growth in an enterprise type of product, which we think is pretty attractive. And the interesting thing is also the amount of capital that you're spending to acquire your customers today is a lot cheaper, just because you can download something for free and try it out. Whereas in the pre-cloud era, you would spend a lot on sales and marketing teams and really have to go through a full demo, a whole marketing strategy to just try to even convince a CIO and executive. So you're seeing a lot quicker sales cycles, a lot more efficient growth when it becomes to product-led growth era. And these are some of the sample product-led companies that are more well-known today. Atlassian is probably the best and pioneer of the strategy. They famously grew to over 300 million in revenue before hiring a single sales team. But then we also see recognizable companies like Figma, Slack, Twilio, and Zoom, which have all grown really fast to incredibly high valuations and hopefully good outcomes. And then moving on to a consumption-based model is kind of one of the newer models that we're seeing as far as pricing. So what it's about is for data or API companies, something where the value that you're generating out of the product is how much you use it. They're tying it, so giving you a certain amount of credits that you can use and charging you per credit rather than a subscription, which allows for just like a natural win and expand motion and a more efficient business model. So we actually looked at 12 companies here, 6 product-led consumption-based pricing model, 6 subscription-based. models and compared the two. These are some of the best companies in both of these models. And on most metrics, you can just see how attractive the consumption-based pricing and the product-led motion is. You have just faster, better sales efficiency, faster payback, quicker growth, the natural net dollar retention when you start small in account and then grow to a larger user base. And this is why some of these software companies are super highly valued, because it's not just innovative technology that's growing quickly, but it's also a more efficient and better growth model that's more profitable. And what's exciting about the cloud space and markets that we've seen is the markets are just a lot larger than we expected, and there's more people adopting it. If you look at here, this compares the analyst estimates of some public software companies compared to what they actually performed. Most famously, Shopify and Twilio, I think those were both projected to go towards 30% growth after a few years of IPO, but you can see that they're both very durable and have exceeded expectations. And it's not really just those one or two examples. There's examples all across the board that are demonstrating outperformance compared to expectations. And why we're excited about it is also just because of how early we are still in the cloud. If you can see how much in the green area, just how much more dollars that we spent into cloud computing, it's pretty significant. But if you look at the overall penetration rates, in 2020, we're still at 8% of global IT spend, hopefully double by 2025 to 16%. But it just shows how early we are in the space. And you can see that as these numbers have grown, the exits have also gotten bigger as well. So it's for us, it's just, I think, a super exciting time. We're seeing great innovation on the technology side and the business model side. And to be clear, I think we're still excited about the old enterprise legacy version of selling technology. You're still going after very large contracts on that side and very sticky revenue. And that's actually an important point of inflection for a lot of software companies today, is how do they blend the product blends, the bottoms up approach with the top down sales. And we're seeing the best of breed companies able to accomplish both. So yeah, moving, I think, to our conclusion. Yeah, venture today, I think the dynamic is changing all across the board when it comes to funding, seeing how players like Tiger Global have impacted the entire stack, and how the platforms, the specialists, and the seed investors are all changing. But we do think it's a very exciting time to still be in venture. Digital transformation is driving innovation. Business models are just becoming more attractive, faster, profitable. So we think it's still a really attractive place to participate and put your money into as far as the next 10 years. So with that, we will pause there.